On this channel, I've talked about everything from stocks and bonds to growth and dividend investing, but one topic I haven't really covered is my own portfolio. So today, we're going to take a look at every position, how it got there, and how I pick the companies I invest in. To give a little more context, I like to think of my portfolio as a barbell. The stocks on the far left side are established companies that dominate their industries, spitting off cash flow and returning that cash to investors. To the far right are the small hyper-growth companies with lower cash flows but faster growth. With that said, let's start with the four largest positions in my portfolio: Intel, CVS, Corsair, and PayPal. At 11% of my portfolio, Intel is my largest holding. The recent earnings left a lot to be desired, but the company is still on pace to reclaim its former glory. I see the large slowdown in the semiconductor space benefiting Intel the most overall. Financially, the company is in a far better place than Nvidia and AMD, and while Intel's plan won't play out for a few years, I'll happily collect a nearly 5% dividend yield while I wait. At number 2, CVS is one of my most recent positions. Having quickly made it to the top of my portfolio, CVS is putting together one of the most impressive healthcare companies on the market. Being the owner of nearly 10,000 stores, as well as Aetna and Signify Health, CVS has completely overhauled its business in the last few years to become an all-in-one healthcare titan. Corsair is one of the oldest positions in my portfolio, at one point occupying over 15%. Now, given the recent performance, it has slid to number 3 at under 9%. While Corsair is a market leader in various PC hardware, the main reason I own the company is Elgato. This company, hidden away, is a powerhouse in the streaming space. From microphones to capture cards and their main product, the Stream Deck, Elgato is the go-to company for all things live streaming. Speaking of market leaders, PayPal is another such business, with a wide variety of offerings from the main PayPal business to Venmo, Braintree, and Honey. There isn't much PayPal doesn't do in the payments space. That's why it occupies the number 4 spot in my portfolio. Now, before we continue down the list, let's take a quick look at what it takes for a company to make it into my portfolio. Simply put, there are 4 pillars on which my portfolio is based. The first and most important is cash flow. Free cash flow is one of the most important metrics in all of finance. While companies that lose money aren't completely uninvestable, companies that at least generate cash flow tend to last longer than those that don't. Pillar 2 is diversification, and what better way to diversify than through ETFs? These investing products allow me to get exposure to trends without betting on singular companies. The perfect example of this is DXJ. This ETF takes the number 5 spot in my portfolio and is how I get exposure to Japan. Really, there's a lot to like about this ETF because Japanese companies tend to have high cash flows, low debt, and large dividends. Unique to this ETF as well is currency hedging. This essentially eliminates the risk of losing money on currency devaluation. SCHD is another ETF that looks similar to DXJ. Coming in at number 6, SCHD holds 100 of the most financially strong companies with growing dividends. It's also one of the best performing positions in my portfolio. With top holdings such as Pepsi, Coke, and Home Depot, this ETF once again proves cash flow is king. While the number 7 spot is not an ETF, Sprouts Farmers Market is one of the fastest growing grocery store chains in the country. With most of its growth coming from rapid expansion from coast to coast, Sprouts' unique farmers market approach has allowed it to have higher margins than many competitors. This excess margin cash has mainly been used to buy back stock. But going back to the theme, we have my favorite position at number 8. FRDM is an ETF that allows investors to get exposure to freedom. Literally. It holds companies from emerging countries that rank highly on the Freedom Index. This index, with over 75 factors, can pretty accurately tell how free a country is. The idea is the freer the nation, the quicker the growth. Pretty simple. Simple, just like the next pillar of my process, which is keeping debts low. Having a large debt load is unsustainable for many companies and often leads to ruin. From small companies like Bed Bath & Beyond to mega caps like the former retail giant Sears. years. Some may be confused then at my number 9 position, Store Capital. Typically, real estate companies carry very high debt loads, and Store isn't an exception. The difference is how that debt is used. Store uses debt very well, taking on debt to make great acquisitions, then paying that debt down. This has allowed the company to maintain a debt to equity that competes with the largest real estate companies on the market. To better illustrate Pillar 3, we have positions 10 and 11, Berkshire Hathaway and Boston Omaha. Both companies' operations look fairly similar, acquire good businesses and allow them to grow on their own. Both have kept debt to a minimum and have large cash piles they occasionally draw from to make acquisitions. The ultimate example of this pillar is found in position 12, the Daily Journal. With the market value of just $350 million, the company holds $360 million in cash. And with just $160 million in debt, the Daily Journal can easily pay that debt. It is worth noting, though, that the $360 million in cash is held in stocks, the dividends of which are used to continue to grow the business. Finally, the portfolio is overseen by Charlie Munger, the longtime co-chair at Berkshire. Pillar 4, and the last one I'll mention, is making concentrated bets. You may notice my portfolio only has 20 positions, and it's really 12 positions, as those top 12 account for 80% of my invested dollars. By keeping a limit on the number of positions, I'm forced to find the best companies on the market. That's why I'm not going to go super in depth with the last few positions. These companies and ETFs are positions I've just started building up. Of course, my portfolio is constantly moving, and I'm always reevaluating positions. While this is the current state of my portfolio, I imagine it will look very different in 6 months or so. If you would like to see my portfolio move in real time, it's always public on Common Stock. And while they aren't sponsoring this video, it's a platform I use basically every day, and my personal portfolio is always public there. Another note is these 4 pillars are not the only ones I use to evaluate companies. If you've seen my company deep dive videos, you'll know this is the case. I talk a lot more from revenue growth to shareholder yield growth, but these 4 pillars are considered the most important. With that, I would love to hear your thoughts on my portfolio in the comments below, and while you're down there, tell me your largest position. If you enjoyed this video, I'll bet you enjoy the video on screen now, and as always, this is Dollars and Cents.